The market continued to rally on expectations that the interest rate hike was virtually completed after the FOMC meeting on November 2nd. There was an assessment in the market that the Fed rate hike cycle had actually stopped. As the U.S. Federal Open Market Committee meeting ended, the U.S. 10-year interest rates plunged nearly 20 BP. As the market interpreted that the Federal Reserve System had effectively signaled the end of the base rate hike cycle, investor sentiment that bond interest rates would also peak took the lead. After the FOMC, there is a response from the domestic market that some of the risk of interest rates surges has been resolved as a result of the FOMC. U.S. Treasury yields soared as the Federal Reserve did not let go of the possibility of further raising the benchmark interest rates. The Federal Reserve's interpretation was that this in itself had the effect of raising interest rates. As the U.S. manufacturing industry has recently entered a phase of contraction, there is a high possibility that the U.S. economic cycle may be past its peaks, putting pressure on the Federal Reserve to end the interest rate hike cycle. U.S. Treasury yields, which had been running high, plummeted and the stock market rebounded all at once. On this day, Kospi closed with a rise of nearly 2% due to the U.S. Federal Reserve's decision to freeze the base interest rates. The Federal Reserve System, the U.S. Central Bank, froze its benchmark interest rates for the second time in a row as expected on November 1st, local time. It also decided to maintain the existing base interest rates of 5.25 to 5.5%. This is the second freeze in a row following the FOMC in September. The market had expected the basic interest rates to be frozen, taking into account the tightening effect caused by the recent surge in government bond interest rates. As interest rates on U.S. government bonds fluctuate, hedge funds are rushing to enter the government bond market. This is to increase short-term profits through investments that take advantage of interest rates volatility. They are raising yields by betting large sums of weak government bonds. There are assessments that upheaval is taking place in a quiet government bonds market. Hedge fund managers began to rush to increase the proportion of their investments in government bonds. As of the end of last year, hedge funds' government bonds holdings amounted to $2.3 trillion, a threefold increase from the previous year. It is the highest ever. Hedge funds mainly used basis trading to make short-term profits. Base trading is an investment method that buys spot government bonds and sells short futures. If interest rates rise, the value of the government bond fall, you make a profit. This is a strategy that aimed at institutional investors such as pension funds and insurance companies buying U.S. Treasury futures in anticipation of a pivot from the Fed. Volatility is behind the hedge funds increasing their investment proportion. As volatility in the government bond market rapidly increased, yields were raised through short-term arbitrage. As of the 23rd, the daily interest rates changed for 30-year U.S. Treasury bonds averaged 0.13 percentage points. It is 3 times the average value over the past 10 years. The reason for the increase in volatility is the Fed's quantitative tightening. The Fed, which has increased its purchases of government bonds for 10 years after the 2008 financial crisis, has promoted a large-scale balance sheet reduction starting in June 2022. It began reducing its government bonds holdings by $95 billion every month. Commercial banks also reduced their holdings of government bonds. As household subsidies distributed during the coronavirus pandemic depleted and crude oil price rebounding, the possibility of an economic slowdown is increasing. When the economic slowdown begins in earnest, the interest rates on 2 years government bond is expected to fall to the 3% range.